Hi, I'm Jimmy. In this video, we're looking at an investing checklist for beginners based on Warren Buffett's investing style. Now, I built this investing checklist largely from Warren Buffett's letters to his shareholders at Berkshire Hathaway. Then I also used some letters that he had back when he ran Buffett Partnerships, which was before Berkshire Hathaway. I pulled some information from there as well. Now, if you're curious to go deeper on your own, I really like the book called The Essays of Warren Buffett. And basically what they did in that book is they broke down Warren Buffett's letters to the shareholders and they group it by topic. And it's a great way to sort of break out different parts of what he tries to teach. I've got an affiliate link to Amazon in the description below if you're interested in supporting the channel and interested in learning more about the way Warren Buffett thinks about investing. Okay, so for this video, I've broken down Buffett's investing checklist into 4 main groups when analyzing a company. So we have the business, then we have the financials, risks, and then a portfolio check. Now, the key for a beginning investor is to be able to check off each of these categories as you've done the research and we think each category is good. Now, obviously, we could go much deeper than this if we wanted to, but I think that this is a great place to start, especially for new investors. Now, we're going to look a bit closer at each of these 4 main categories, and we're going to try to simplify it so a beginning investor can easily find out whether or not they think that each category is good for a particular investment. Let's kick it off at the business section. So broadly speaking, we can break this business section into 2 main categories: understanding the business and the company plan. So how do we know if we understand the business well enough, or how do we go about understanding the business? Well, there are 3 main things that a new investor can focus on to completely understand the business, or to more completely understand the business. First, we have the corporate structure. Then we have, does the company have any competitive advantages? And then I think the key to this whole thing is understanding how the company's cash flows, or better put, how money flows through the company. Okay, great. And I'm sure we've all heard Warren Buffett talk about each one of these at some point or another, even if it wasn't presented in an investing checklist style. But the question is now, how do we do this? Where do we find this information? And for that, I think the most important place to start is the company's annual report. So in the early part of any annual report for a company, well, there's going to be a business section. Using Coca-Cola, which is one of Warren Buffett's largest and longest holdings, as an example, if we were to use that as an example, their business section is only about 8 pages long. But in that, they break down both the corporate structure and they talk about the competitive advantage of the company. Now, this is a great way to set up understanding how money flows through the company, or how the cash flows through the company. For that, we can also use the financial statements, which we're going to get to in a second. Now, for the corporate structure, what we care about there is how do they look at their business? So in the case of Coca-Cola, as an example, well, they break it out by different segments. They have Coca-Cola bottling, and then they have different regions they break it down. Well, we want to know that because if one region is doing better than another, then that allows us to analyze that region in isolation. It makes it much easier to understand the company if we know how the business or how management of the business looks at the company. Knowing that will help us define whether or not there's a competitive advantage. Warren Buffett calls this a moat. And then when it comes to the cash flow, well, let's just illustrate this real quick just to give an example. Using Coke as an example, let's pretend that Coca-Cola has $100 to work with. Well, they have that $100, and the first thing they're going to have to do is start creating product. About 40% of that $100 goes towards creating the product. Well, then they have to sell the product. About 32% of that $100, in Coke's example, goes towards selling the product, selling general and administrative. Well, then they have to pay interest. For Coke, it's about it's about 1% of the total 100. So dollar goes towards interest. Then they pay a few dollars towards taxes. Well, overall, they end up with profit margins of about 20%, which in our example is about $20. Well, just creating this type of visualization allows us to better understand what's happening with the company. So if management comes out and says that they've lowered their cost of goods by 10% or increased it by 10%, well, we know that the number at the top will get bigger or smaller depending on what they've done. This gives us a true understanding of what's happening with the business, and I believe this would meet the criteria that Warren Buffett has laid out for you need to truly understand a business before you invest in it. And this brings us back to our checklist. So in the checklist, we have growth, and this is focusing on where we believe the growth of the company is going to come from in the future. And then we have management versus their own history. And for this, well, here we're looking at in any annual report or quarterly report, there's a section called Management Discussion and Analysis. And in that section, they're going to lay out their business plan, where they see the growth coming from, and then what they think that type of growth will provide for the company. So our question is, do we believe in management's plan? Does it make sense? Do we think it's realistic? And then when it comes to analyzing management versus their own history, well, what we can do is we can look at, let's say, last year's management discussion and analysis section and look to see what they said they were going to do. Did they do it? Did it work out the way they will? Did they over or underestimate the impacts of their plan? Well, if we would answer those questions just a few times, just a few years going back just a few years, well, we can get a much better understanding of the quality of that management. Okay, now let's pretend that we've completed everything on this one checklist for the business section, and we really like this company. If we really like it and we can check off each of these boxes, we like what they're doing, we like their plan, and we think that they have the ability to pull it off. Well, we can add a check on our main checklist for our main groups here. Well, now we can add a check to the business section. Then we move on to the financial section. Now, we don't necessarily have to move on to the financial section. If we have question marks about the business section, we should simply move on. Warren Buffett says that investing is a game where that we can wait for the perfect pitch. We don't have to swing every time. If we don't like the company, if we don't like the business itself, we can simply move on. We don't have to waste our time analyzing the financials. But if we do, let's jump into the financial section to see what we should do over there. Now, the financial section is a bit easier and a bit faster to go through. It's more just basic numbers. It's a simpler checklist. And here, we're going to look at the income statement, the balance sheet, and the cash flow statement. In the income statement, two of the most important things we want to pay attention to is growth, then profitability. Now, when we look at growth, once again, sticking with Coke as an example, well, this is a chart of Coke's revenue. And clearly we can see that Coke is heading in the wrong direction. So revenue growth has been negative. Now, when we look at the earnings per share, well, now this looks quite different. We're not sure why yet. We'd have to dig into that. Maybe they bought back shares. There's lots of ways this could happen, but getting an idea of the growth overall will help us further understand the business and how they're making money. Now, what about profitability? Now, usually we can see profitability in the margins. So for that, we're going to want to check gross margins, operating margins, and net income margins. Using net income margins as an example, well, this is Coke's net income margins. And we could see that Coke's net income margins actually got stronger. Okay, that's a good thing. Now we slide into the balance sheet, where we're going to look at two main categories, liquidity and debt. Now, for liquidity, there are a few ratios or a few important liquidity ratios that Buffett says are important. A lot of them depend on the industry, but broadly speaking, we're looking at the cash ratio, the current ratio, the quick ratio, and he also likes debt to equity. Now, debt to equity helps push us to our debt analysis. So here, we're looking at ratios like the debt to equity ratios, but we should also look at interest coverage. And another great shortcut for understanding the balance sheet and debt in general is to look at the company's credit rating. Oftentimes, rating agencies will map out what they like and what they dislike about a particular balance sheet. So overall, obviously, we want debt to be as low as possible, and we want the company to have at least enough revenue to cover any interest payments that they may have to make, or when they have to return the principal of bonds to their investors, we want to make sure they have that cash on hand. And this leads us to the last section of financials, and that is the cash flow statement. Now, in the cash flow statement, I think it's best to focus on free cash flow. Buffett is always preaching the strength and the importance of a company's free cash flow. So for that, we're going to want to look at the operating cash flow section of a company's cash flow statement, and we're going to want to look at capital expenditures. How are capital expenditures trending? Are they trending higher, lower? How do they compare relative to the cash flow from operations? Those are the two most important numbers on the cash flow statement. Ideally, the higher the cash flow from operations is, the lower the capital expenditures are, That means we're going to have higher free cash flow. That's what we're after there. Okay, simple enough. Now we're jumping over to our third section, and this one is risks. Now, the final two sections here, they're going to be a bit quicker and easier, so we should move through this whole thing much faster now. Under the risks section, we're first going to look at self-check, and then second is pre-buy questions, especially for beginning investors. These are questions that we should always ask ourselves before we go ahead and buy the stock. So, under self-check, the first thing we need to ask is, where could we be wrong in our analysis? And basically, this gives us a chance to say, okay, what if the plan doesn't work? Or what if margins get worse? Or what if they get better? Or what if they make a new acquisition? Does that acquisition play out? This is a chance for us to challenge our own investment thesis. In doing this, we're going to get a better understanding of what we should look for either on the positive side or on the negative side. And then we want to ask ourselves, is anything here too good to be true? Maybe their profit margins are way higher than their competitors, or they have almost no debt, or their growth rate is significantly better than everybody else's. And this is an important point, because through almost all of this, we're going to want to compare our company, whatever we're analyzing, to other companies. Because if we don't have something to compare it to, how do we know if something looks too good to be true? So at this stage of the game, it's a good chance to go over and analyze a few competitors. Even if we just do, let's say, the financial section for competitors to give us something tangible to compare our company to. And then into the pre-buy questions, well, here, the first thing we want to do is compare our potential investment to other potential investments. Doesn't necessarily have to be in the same industry. You might have two investments that you're considering, that you're waiting for, and comparing which one should get our capital first. We all have a limited amount of capital, so we want to be very careful with where we put our investments, where we put our money to, which investments we put our money into. Now, when I was reading through Buffett's shareholder letters, I noticed how often he talked about the quality of his investments versus another investment, or an opportunity versus another opportunity. So I think for new investors, this is a great place, for any investor, this is a great place for us to consider, great question for us to ask ourselves. Okay, then we ask ourselves, does this investment have the margin of safety we need to get involved in it? Now, I actually did a whole video on margin of safety, so I got links in the description below if you're interested. But assuming that we love the business and they have solid financials and we're checking off each of our boxes and we say, okay, this is something we want to get involved with. The concept of margin of safety is, where do we get involved with enough upside to make it worth the risk? Because every investment at the end of the day has some risks. How do we limit that risks as much as possible? Once again, whole video on that if you're interested. And this brings us to our final and perhaps most underappreciated aspect of building a great investment portfolio for beginners, or really for anybody. And that is taking a big picture look at our portfolio. So first thing we're going to want to do is look at the correlation to our current portfolio. So if we're considering adding an investment, how does that investment fit into the portfolio as a whole? If we own 3 automobile companies, does adding a 4th automobile company help all that much? So we want our correlation to be as low as possible. And in theory, if with a lower correlation, if one of our stocks fall, well, perhaps this one won't do as bad. Maybe it even does a little bit better. That being said, this leads nicely into the next one, which was, are we sure that we have the best investment type? So maybe instead of buying stocks, we should buy bonds or preferred shares or stock options. We have to see which one fits our situation the best. Now, for beginning investors, I think it makes the most sense to stick with mostly stocks or bonds. But if we have a company that we love and they have great financials, but perhaps growth isn't where it needs to be overall, or perhaps the pricing of the stock is just too high, maybe their bonds are priced a little bit better. Maybe that provides the interest income that we need from this company. Oftentimes, companies issue convertible bonds that can be converted into stock at a later date. That might be a great investment. So pausing to reflect on, do we have the best possible version of this investment, makes a lot of sense for an investing checklist. Okay, so that's our entire Warren Buffett investing checklist for beginners. And like I said, we could go much deeper into this for more advanced investors. So if you're interested in seeing something like that, please let me know in the comments below, and I'd be happy to put something like that together. Do you think that I missed anything on that Buffett would have included had he ever put out an investing checklist? Please let me know what you think in the comments below. If you haven't done so yet, please hit the thumbs up, the subscribe button. Thank you so much for sticking with me all the way into the video. I'll see you in the next video. Thanks.